Hello and welcome to the 9th edition of Aditya Birla Sun Life Mutual Fund presents Voyage 2022, partnered by ET Now, which was recently conducted virtually. The flagship event saw a stellar lineup of speakers from across the mutual fund industry decode their vision for what lies ahead for India in the post-pandemic world. Here are the highlights.
I have with me joining in right now Nitesh Jain, Jonas Gupta, Chanchal Khandelwal, as well as Dhaval Shah. Gentlemen, hi, good evening. Good to have all of you on board. Dhaval, let me start off with you, considering you are tracking, if I can call it, the most fragile sector right now, consumer durables. Largely the input cost pressures, the entire inflation around us, everything from crude or fuel rather, to just everything that we're consuming right now is just getting so expensive. And that's the first port of call where consumers are going to get a little price conscious when it comes to consumer durables. What, according to you, Dhaval, then are going to be the key demand trends that you decipher in this post-COVID world?
Let's look at demand in the post-COVID era over the last 2 years, how things have actually panned out. And the first thing that you would see that, post the opening of lockdown, many people were positively surprised with the kind of, the demand uptick which was there, or the pent-up demand which was there, across the consumer durable sector. And largely, people looked at the reasons to see that why is that happening. And we figured out that, there was a lot of reverse migration of labor from urban areas to rural areas. There was urban consumer who wanted to buy things like, microwave ovens or dishwashers where sales went up 3x, 4x, largely to make their lives more comfortable in the absence of any other help that you're trying to look at when there was a lockdown. And it was a euphoric year of FY21 where, there was a big delta change in demand that you were trying to look at. Over the last 9 to 12 months, as you rightly pointed out, because of inflationary pressures, there is a dichotomy here when we look at demand, numbers in an overall sense, that whatever is related to the mass segment is witnessing, lower volumes. In many cases, volumes are lower by 8 to 10% on a YOY basis, or even a 2-year CAGR basis, slightly negative on an overall volume basis that we're trying to look at for mass segment, which is where the pinch has been the much harder because of inflationary expectations. But premium segment continues to do well. So any company which is geared towards premium segments continues to see very robust numbers. They are not only being able to, pass out the whole of inflation which has been there, plus there has been a decent volume growth, which is there on the premium segment. So that is the near-term outlook that has been there on the overall demand side, and we would continue to think that will continue over the next 12 months also.
Nitesh, at the other end of the spectrum is the sector that you track, infrastructure and cement. What kind of opportunities do you think lie for the infrastructure sector in India, and what kind of reforms do you think the government has undertaken as we come out of COVID?
So basically, the key enablers for the infrastructure in the country are basically two factors, right? One is the interest rate, and the other one, the important one, is the government finances. Now, if you take a historical backdrop, clearly these two factors right now are quite supportive. We would have seen the GST collection number, monthly numbers, or the advance tax collection revenue numbers of the government. And also the interest rate in the country compared to the historical trend are quite low. So my sense is that these are conducive for a long-term infrastructure build-up. Our country a lot has to be done in the future. And in this backdrop, if you look at the government of India, a couple of years back, they have come out with the NIP, the National Infrastructure Pipeline, wherein they have put across nearly $100 trillion worth of outlay over the next 5-year period. So I would say there are it's a very broad sector or broad space to look at. But clearly two things which stand out, which are also critical from a capital market point of view, which gives the investable opportunities as well, are highways and the water related infrastructure. So two schemes which are part of the NIP. One is the Bharatmala project phase 1 and phase 2, wherein the government has said they will build nearly 70,000 kilometers of highways. Out of the 70,000 phase 1, phase 2, 18,000 kilometers have already been awarded and are under implementation. And second big opportunity which I can see on the water side, wherein we have committed that in next 5 years, each and every household in India will have a potable drinking water. And these two things, we have actually seen implementation on the ground. The listed companies in India, they have started getting orders. Implementation is already in place. So all in all, it's quite positive.
Sure. Jonas, if Nitesh is that bullish on infrastructure as a sector, I bet you think industrials are going to do very good in the next 2 to 3 years, wouldn't you?
Yeah, absolutely. So picking up from where sort of Nitesh left, so there are a couple of other things that sort of are driving demand for industrial. So some of them are largely globally induced, things like China Plus One, which is more a post-COVID realization by global companies looking to reevaluate their supply chains, and which is where sort of India fits into the picture. The other is, again, global countries sort of incrementally becoming more uncompetitive in the overall scheme of things and are looking at other avenues to produce products from. So these are two global trends that we are seeing that are benefiting a lot of industrial names. Overall, over the next 2 to 3 years, I would believe that all of these things put together would lead to better times for the industrial sector.
Chanchal, where lies real estate? Because, real estate, the sector that you track closely, is coming out of a decadal bear market, right? We can see that reflected on the stock prices. But, the underlying theme remains the same. Real estate needs cement, real estate needs steel, real estate needs labor costs, and all of them have seen a big spike in inflation.
If I look at real estate as a sector, and if I take a step back, if you see 2016-17 is the first time when the reform started. RERA was the biggest reform. What RERA did was that from companies who were taking out cash from the unit level of the project and taking it at the company level and funding the cash flow, that was disallowed. That means that the project money at the project level has to be used. Then ILFS crisis happened, which further reduced the cash flow in the sector, and then you had DMON and GST. All this made sure that the tightening of this sector, the cash flow or the fund requirement of the sector was tightened, and that was the reason the sector itself went through a big correction. Now, if I look at from a COVID world, post-COVID, all of us realize the importance of home, not just owning a home, but owning a better and a bigger home, right? So from that perspective, 2021, as I tell it, it was a start of a real estate cycle. It was like a Goldilocks situation when the interest rate was at an all-time low. COVID made people realize the importance of home. The consolidation in the sector, which was started was happening, and the inventory in the system was almost at 4.5-5 years. There's 10 lakh houses which was not sold. In fact, in 2021, the absorption was higher than the launches for the first time in the decade. And normally the cycle starts when the absorption is higher than the launches. And today the inventory is almost at 2.5 or less than 2.5 years. And I think this cycle which has started will continue for some time. And the reason of belief is that, IT as a sector has come back and the kind of salary increase in this sector which has seen is almost is high. And we think this IT boom will continue.
Thank you so much for speaking with us and discussing all the islands of opportunities that equity investors can look at. Chanchal, Jonas, Nitesh, Dhaval, all of you have a great evening.
Welcome back to Aditya Birla Sun Life Mutual Fund presents Voyage 2022, partnered by ET Now. In our next session, we had Tim Moe, a well-known name in the Indian and global financial services space, talking about his view of the scope of growth in emerging economies post the pandemic. Let's listen in.
The attendees here are distributors, they're investors, and they are also advisors to clients. And the question which perhaps everybody wants to understand from your standpoint is that what is the best way to make your portfolio or your wealth Teflon coated, if I may use the word, against inflation?
It is a great question, and it's obviously a difficult one. I mean, I think there's we live in such an uncertain and capricious world that I wouldn't want to say that you can sort of, bulletproof the portfolio. But what I think we can say is that in a world where inflation is rising, the relative attraction and performance of real assets that are more linked to the real economy, tend to do better than some purely financial ones. And so in practical terms, that would suggest and reinforces our view on being overweight commodities. We still think that the market's underpricing energy stocks, for example, and some of the metals and mining stocks. We think that gold has a place in the portfolio. Gold is a strong place in the Indian heart, so that will, I'm sure, resonate well. Real property and other sort of real assets should be favored, but there are definitely parts of the market that look better.
For next 3 years, do you think one should expect low returns, no returns, or high returns?
I'm going to give you a kind of a two-pronged answer. And I'm not trying to be a two-handed economist here, but I think there really are two important points to bring out. So number one is that if you look through financial history, and there's tons of textbooks and learned studies and all this, one of the most significant determinants of future return is the price you pay at the start of your investing period. So it's not surprising if you pay a high price, it's harder to have a higher return over time. And if you start with a lower price, you generally had a much better potential for return. So just purely from that, it would say if your starting point for India is paying over 20 times earnings, then you shouldn't expect as strong returns as perhaps we've enjoyed over previous, call it 5-year investing intervals. However, and this is a really strong caveat to that, India looks like it will be able to deliver quite strong earnings growth because of the very favorable underlying fundamental dynamics. And on top of that, and we've written a detailed paper on this late last year, we are very excited about the theme of what you might call the increasing digitalization of the Indian equity market.
So, Tim, irrespective of the timeline we are talking about in the history, markets, they follow a cycle. It starts with skepticism, then there is participation, then there is euphoria, bubble, and a bust. At what stage do you think Indian markets currently are in?
I think right now we're in a period where it's really the growth phase, where valuations have expanded, and now it's going to be the earnings growth which catches up. We'll probably see some forward valuation compression, but as long as the growth comes through, I think we're going to be in that longer growth phase for India.
Tim, I distinctly recall a conversation on some other forum a couple of years ago, and this was once upon a time, literally, in life of a strategist. You made a call that you see a lot of domestic money coming into India. It was an outlier comment a couple of years ago, but look at the reality. It is now part of an Indian saver's life that you're investing into equities. Could that be the differentiating factor, Tim, which will keep Indian markets always at a premium, because demand now from the domestic folks is much higher than the supply coming from the global folks?
Well, it's a terrifically well-asked question, and thank you so much for remembering what we said. Yeah, it's good you remember the good things we said, not the bad things we said.
You said good things about India, so I like to remember them.
Yeah, okay. But in all seriousness, this is a very important point, and it's something which is, I think, particularly critical to all your distributors, who are the attendees at this conference, because I think this really is sort of the, their lifeblood, so to speak. And really the point here, the concept is the term we've dubbed, so to speak, is what we call the financialization of Indian household savings. So the concept is that Indian households save a lot. They've got a very strong and robust balance sheet, but the majority of it is in property, it's in cash, it's in gold, either around mother-in-law's neck or in the drawer, but not that much of it is in financial assets. And our view, based upon looking at how various other economies have developed over time, is that there's going to be a development of financial market investment, and there will be a structural shift and embracing of financial market investment by the Indian household. And so we think there's a long way to go in this, because if you look at the current deployment, we're still well below 10% of the household balance sheet being invested either directly in the equity market or through mutual funds or other similar intermediaries. So there's a very clear long-term structural trend of increasing share of financial assets in the household balance sheet, which itself is going to continue to grow as India's economic growth increases and people's wealth rises. So we think this is a really strong, fat, long-term trend, which is quite positive.
So my last but one question, Tim, is that if I look at financial history, there are decades when a region in the markets does well, whether it was Japan in 80s, followed by US markets, China, last 10 years dominated by US blue chip stocks. What are the chances that next couple of years could be a linear growth market? India could be a linear growth market like we saw in US in last 10 years.
You say linear in terms of like that sort of India in particular could be kind of more on a secular uptrend compared to other markets. Is that your question? So
you could get one bad year, but a couple of good years.
Yeah, I mean, I actually have a lot of sympathy for that view, and this gets back to the kind of the longer term comments I was making before about this change within the Indian stock market and economy. This greater embracing of the digital economy. And forgive me if I'm telling people here something that they already know and living and breathing, but we think there's actually a lot of positive potential in terms of what you might call the digital common good, which has been put out. And this, of course, is the India stack of the Aadhaar, biometric identification, the banking, the capability of doing digital banking, the KYC capabilities digitally, and then of course the universal payment interface, which allows for cashless transactions. The combination of this is the analogy here is with the construction of the U.S. highway system in the 1950s, which was something that had tremendous ripple effects. It was sort of a common social good that was put in place, but that connecting the U.S. by that highway system engendered a huge growth, productivity spurt, and a growth spurt. And I think the analogy here is you've got a digital highway which has been put in place, which is a common good, and is enabling the rapid formation of companies on top of that. And it's also including the vast majority of the Indian population, which previously was in the informal or the gray economy. And the potential here is that for however strong India's growth could be, that digital good and investment which has been made could actually boost up India's growth rate, even further. We don't know what that is. Could it be 1 percentage point or, more or less? But it certainly is a positive. And as that starts to be explored more significantly, that could lead to a structurally higher growth and better earnings and so forth. And that could give us a much better longer term Indian investment story. So, we're on board with that longer term picture.
So we look forward to have you soon in India, and it was lovely to meet you again.
Thank you so much for the opportunity.
Welcome back. You're tuned in to Aditya Birla Sun Life Mutual Fund presents Voyage 2022, partnered by ET Now. Our final session at Voyage 2022 was an interesting discussion on why there is a need to spread your capital amongst different investments in order to minimize the overall risk. The panel was moderated by ET Now's Aisha Faridi.
So I want you to first begin by talking about why asset allocation and diversification is a must for your portfolio.
If you are investing, across assets, it's important that you diversify your portfolios because, as you say, if you put all eggs in one basket, you would want to diversify your risks. So you would want to look to have a core portfolio, a satellite portfolio, and a strategic portfolio, basically, to keep your liquidity needs. You also would want to build a core portfolio and as well as a satellite portfolio to enhance the returns on the investment as well as diversify in case of any asset class underperforming the market.
Mohit, if I could, come to you and pick up one instrument here. That's index debt funds. Now, one has seen that there has been a lot of flows into this instrument. For all the viewers who are joining in right now, and for all those who are seeking advice on this, tell us, how do index debt funds work? And what exactly are they? And why is it that one should even look at them as an investment instrument?
So broadly, it is a passively managed fund, which actually tracks a predetermined index. So that is what an index fund is. Now, what is the advantage of an index fund? So first advantage is that it is very easy to understand. So for example, if you have a 10-year GSEC index fund, then you know that it is going to track the return of a 10-year GSEC. If you take an example from equity side, if you have a Nifty 50 index fund, then it is going to track the return of Nifty 50. So it's very easy to understand. Second advantage is it is a very low cost vehicle, and at a very low cost point, you get a very well diversified portfolio to invest.
Sure. Just talking about few of the products, what are the advantages of, say, a fund of funds? And what is so different about Aditya Birla Sun Life Asset Allocator Fund of Fund?
Yeah, Isha, I'd like to start off from your first question.
Sure.
So why asset allocation is important, because that leads into the importance of fund of funds. Like if you see the past, even the past 5 years, it's been very difficult to predict which asset class could do well. Like, every year, either it has been domestic equity 1 year, next year it has been fixed income, third year international equity, fourth year it has been gold, and so on, right? So from an investor's portfolio point of view, it's very important to have at least these 4 asset classes, and in addition to real estate, in the portfolio, because these asset classes are negatively correlated. They have different cycles. So if one asset class doesn't do well, then some other asset class does well. And that's how you get a stable risk-adjusted return. So that's the starting point, right? And that's where fund of funds come in, because as a product, for example, the Aditya Birla Sun Life Asset Allocator Fund of Fund provides exposure to 4 asset classes: domestic equity, international equity, fixed income, and gold, right? And as I explained, in any environment, especially if you see the past 2 years, the markets have been very volatile. And as Tim also mentioned, even the next 1 or 2 years are expected to be very volatile. So in these kinds of conditions, the fund of fund can ensure that the overall portfolio volatility will be lower, and hence you can get better risk-adjusted returns. The second aspect to understand is that instead of investors trying to monitor markets, time the markets, and get in and out of funds, stocks, or asset classes, they can just invest in this one fund of fund, and they get exposure to the underlying asset classes and the funds. And the fund of fund portfolio is aligned to our fund house strategy, our outlook. We make the necessary changes in the asset allocation and the underlying funds. And the investors don't need to do any of that. And the third is all the advantages they get. So one is, if they make the underlying changes in the portfolio, they need to pay short-term or long-term capital gains tax. But if those changes happen in the fund of fund, investors don't need to pay any tax as long as they don't redeem the fund units. A dedicated portfolio manager manages this fund of fund. Overall volatility is lower, and the overall cost also is lower. So that's how I think, especially looking at how markets have trended over the past 2 years and what we can expect over the next 2 years, a fund of funds would be an ideal product for investors to look at.
That's all from the 9th edition of Aditya Birla Sun Life Mutual Fund presents Voyage 2022, partnered by ET Now. This year's theme, India Navigating with Resilience, saw a plethora of subject matter experts share their outlook with our viewers. Thank you so much for watching.